This is the meeting of the OPEB Investment Committee. I'm going to first, because there's a lot of new faces here today, I'm going to ask us to go around just to introduce ourselves and who we are. And Tony, if you don't mind, I'll start with you.
Sure. Tony Porter, I am the FCTA rep for OPEB. I am a teacher at Frederick High School for 9 more days.
She's not leaving.
No,
yeah.
I'm going to Windsor Knolls. Back to Windsor Knolls, that's where I am.
And I'm Rob Rudo, I'm with HR. I hire and recruit teachers.
I'm Christian Severe, so I work with Siegel Marco Advisors and Renew Investments. Happy to be here.
Welcome aboard. Leslie Pellegrino, Chief Financial Officer and the trustee for the OPEB Trust.
Derek Hoover Beat, Assistant Principal at Monocacy Middle School, but I'm also the Vice President at FACASA, so I'm FACASA rep.
I'm Missy Dirks. I am the president of the Teachers Association, and I'm replacing Tony. This is Tony's last meeting.
I'm George Basco, I'm a PD member.
I'm Renee Milburn. I'm the restricted fund accountant and the AMT member representative.
I'm Dean Rose. I'm Vice President of the Board of Education.
And I'm Catherine Rich. I'm the executive assistant to the board.
Well, welcome everyone. And as you mentioned, this is Tony and Rob's last meetings. They are exiting after, I think both of you served 2 terms, correct?
Yeah.
Very nice. Well, thank you so much for your time on the committee. And Missy will be replacing Tony and, oh gosh,
Megan Quinn.
thank you. Megan Quinn from HR will be replacing Rob. We've got all that set. The board approved all the appointments, and also Brian Roop, or another community member, and Sharon Eber, the base representative of our support employee union. Both of them have agreed to another term, so those are all set for July 1st. Alrighty. Real quick, I have to do the official closed session minutes. In accordance with Maryland's Open Meeting Act, General Provisions Article 3-305B, the other Post-Employment Benefits Trust Fund Investment Committee met in closed session at 9:00 a.m. on February 24th, 2023 via Google Meet to approve the November 18th, 2022 closed session meeting minutes. We also sent out, or Lynn sent out, the February 24th meeting minutes. Hope everyone had a chance to look those over. Any changes needed? All right, in fact, do I have a motion to approve those?
I motion to approve the Friday, February 24th, 2023 OPEB meeting minutes.
Second.
All those in favor, raise their hand.
I was.
Yeah. And you're not official yet, or?
Exactly, I'm not voting. I know, I'm not voting on it.
All right, thank you. Well, and again, I want to welcome Christian to the team. Siegel Marco Advisors is the new investment consultants with us. And he has in the investment report from March 31st that he is going to review with us. And we'll go from there.
Great, thank you. So as I said, pleasure to be here. You will also see my colleague Tanya Keaty at future meetings, so we're going to be working together pretty closely on the relationship. So I've got 3 items. One is a performance update. The second is a review of the plan's trust asset allocation, which I think is an important exercise to go through, especially early on in the relationship. And the third is just a proposed timeline for future meetings, just to get a sense of what we're going to be doing, get your input, and answer any questions you have. So I will say we all have a tendency to use jargon and move at different speeds, and I want to make sure everybody's sort of that I'm presenting effectively. So don't hesitate to raise your hand and ask questions, or just let me know if you need any clarification. So we start in the thick book. This is the update of performance through the first quarter. And I'll go light on the overall market commentary, but if there are any comments, questions, happy to spend some time there. If you flip behind the first tab of page 3, what we're showing here is different benchmarks in the investment world and the various returns for periods of time. So the light green bar is what's happened in the first quarter of 2023. The green bar looks back 12 months, so going back to the second quarter of 2022. As I'm sure you all know, 2022 was a wretched year on just about every front. So this is good. This is some reprieve from that. Just for context, U.S. stocks were down about 18% last year. US fixed income or bonds were down about 13. So that combination is what really made things so terrible because historically, most of the time when you've seen that sort of negative return in stocks, you've had bonds be supported in the market last year. We know that's because inflation was a huge problem. The Federal Reserve was raising interest rates and doing that at a very aggressive clip. So as a result, bonds, refer to the yield curve, which is basically a plot of maturity of bonds and what their yield is. The entire yield curve moved higher because you now need additional compensation for the fact that interest rates have moved up. So that's a really tough dynamic for bonds and it had impact on just about every asset class. So as I said, good news here, if you look at US equities on this page for the first quarter, up about 7%. International equities were up even a bit more than that, which is a surprise to a lot of people, but there are reasons for that, including winter not being as terrible, the energy crisis that everyone expected as a result of the invasion of Ukraine because of the more moderate weather wasn't quite as bad. And emerging market equities, which you have a small exposure to through the International Equity Fund in the trust, that was a bit more modest of a return. So all in all, about a year's worth of stock returns in a quarter. Obviously, we don't know that we're going to end the year there. I have to get through quite a few things here, including getting the debt ceiling lifted. If you look a bit further to the right on the page, U.S. fixed income, as I mentioned, was also down significantly last year. It's up about 3% for the first quarter. So again, looking back at years past, that's about what you would have expected out of bonds for a year. But you can see still down about 5% over the trailing one-year basis. And then as we move further to the right of the page, we get into some alternative asset classes. We're going to talk, as we move forward about some of these and explore whether they make sense. And we'll talk about that more. But
Can I ask a quick question just to make sure? So the world equities is the aggregate of the other three to the right?
Exactly.
Okay,
Yep.
just making sure I was
Exactly.
understanding that.
And we're not in the last group, the commodities, real estate, private equity, those type of items. We have not gone there. Our investment policy statement actually allows us to go to private equity. I think it allows us to go to real estate too. We just have not gone there yet.
Just in terms of other economic headlines, we are seeing inflation come down. It's not going down as quickly as everybody would like and the Federal Reserve would like, but we peaked out at about a 9%, 9.1% headline CPI, Consumer Price Index, reading in the middle of last year, down to a bit below 5% now. So the trend is right. There's still some concerns there about the underlying components of what's driving it. Overall, just given how much the Federal Reserve has hiked rates, it's kind of surprising that the economy has been as resilient as it has. You are starting to see things slow down a bit. The labor picture, and I'm speaking in very general terms, is softening a little bit. But overall, I'd say that theme of resiliency has been surprising to some. I think there is an element too that a lot of this action the Federal Reserve has taken, it takes time to flow through the economy. So we can still see that. I'm going to just skip ahead and go back to that yield curve on page 13, and this will be the last slide, unless there are questions. So page 13, first the chart on the bottom right, that green line is what the Federal Reserve has done going back to 2018. So pre-COVID, they had already started to cut rates, got down to a zero interest rate, held there through the COVID period, started coming out of COVID, very slow. I think you can say that objectively to sort of start to react to the threat of inflation. But once they started to hike rates, they started getting very aggressive. And you see that in those large steps up towards the summer through spring, fall months of last year, 4 consecutive 75 basis point rate hikes. That's very aggressive tightening. So again, that goes back to the point about the impact on the markets and why we saw such negative returns. The impact above that on bonds, so again, this is that yield curve, where on the bottom axis, the horizontal axis, is the maturity of the bonds. The vertical axis is what they yield. That brown bar is where we were coming into 2022. And the orange bar was the end of 2022. The green bar, or the green line, is where we ended first quarter. So that is a pretty unbelievable increase. We went from a federal funds rate of 0 to north of 5% currently. Short-term bonds, if you look at the 2-year bond, went from about 1% to over 4%. And the 10-year bond, which a lot of people sort of reference as the benchmark for bond yields, that went from about 1.9 to up to over 4%. So again, I think that's just important, and then this is all going to feed into the asset allocation conversation because it does have an impact on our modeling and what we sort of recommend. Any comments, questions? No, I glazed over a lot, but.
It's interesting how, from an investment perspective, this is good for us, but from a borrowing perspective, from our local government, who borrows money for us through bonds to build, it takes out some of their buying power.
Exactly. Yep, everything becomes
Unfortunately.
more expensive.
Yep.
Yeah.
Plus on one, negative on the other.
Yeah, exactly.
And that's the other thing about the upshot of what we all went through last year in bond world is because the returns were so negative, because yields moved higher, you have to sort of separate what happened then from what's going to happen now, because you have there's so much more cushion built into bonds in the way of yield that you get now that you didn't get before. Talk about that a bit more too. Okay, so the executive summary is behind the second tab, and that's on page 24.
Oh, yeah, the color chart.
It looks like abstract art. I'm an art teacher, that's it.
You love that.
You refer to that as a book.
Well, it does look like a book.
So page 24 is just a summary of the quarter. So assets, quarter over quarter, end of last year through first quarter, up from 148.9 to 158.9. A nice increase. 9.5 million of that approximately was from investment gains. 500,000 was from an additional contribution into the trust. And I understand that will be the only contribution for the.
At this, unfortunately, it appears that we will not be making a contribution next year.
So the return, you see it there in the middle of the page, 6.3% for the quarter. That was about 0.4% or 40 basis points better than the policy benchmark. If you look at the underlying components, we have a lot of detail on this, but I'll just give it to you verbally. There was a slight underweight to equity, large cap U.S. equity, underweight meaning that the amount the trust was actually allocated relative to the policy, the stated percentage of the policy was slightly below. And because U.S. equity large cap had such a strong quarter, you didn't benefit quite as much as the policy index that you're measuring against. But offsetting that was strong performance by the International Equity Fund and then your two fixed income funds. See that in just a minute as well. So for the fiscal year to date, 9 months through, up 7.5%. That's ahead of the 6.5% actuarial assumed rate of return, so that's great. And the asset allocation is all within the targets that are in your investment policy statement. And to just note that Western had been on your watch list with the prior consultant. We made the decision to keep them on there. We have seen periods of time where Western has underperformed, and historically they've come back pretty well. And really, if you look at their performance, and not just on an endpoint basis, but sort of their rolling performance over time, they have been a very good performing manager. They do take more risk than a lot of fixed income managers, but I think the important thing to keep in mind is the mix that you have within fixed income and the fact that you have two managers and they're sort of complement. Page 26 and 27 are just summaries of what I just described. I'll make one point on 27, which is even after 2022, we've established what a terrible year that was. If you look back 3 years, the far right column, the trust has still added close to $42 million in investment gains. That was on a base of a bit north of 100 million at the start of the period 3 years ago. So that equates to about 11.5% annualized return for a 3-year period. Page 28 is the eye chart, and where you really look at how the funds have done. So you see the total assets at 159 million at the top left. That top line, the total fund is for the entire trust performance, and then again we compare that to that policy benchmark. And just as a refresher, that line underneath it, the Frederick BOE policy benchmark, what we're doing there is taking indexes and we're applying the weights that are set in the investment policy statement, and that gives you an idea of how your performance is compared, how the trust performance is compared to a reasonable index based again on what are considered passive investments, index funds like the S&P 500, but weighting them into your policy. So good. The only real eyesore here is the 1-year number, but certainly looking out longer term in the fiscal year so far, good results. I mentioned the slight underweight to large cap equity. We are going to have a recommendation today to do some consolidation in that top piece under domestic equity. So you have 2 index funds there. We think there's a way you can consolidate into one and save a bit of money for the trust. We'll get to that in a little bit. The fund in the middle of the page, American Fund Zero Pacific Growth, that's what I mentioned is the international fund. A very good quarter. You can see it was up close to 10% just for the quarter. And the broader international benchmark was up about 7%. I think interesting to note, if you look at the S&P 500 index, which is under that Vanguard Institutional Index line, you look at the fiscal year to date column, if you scroll to the right, it's about 10%. That's actually identical to what we've seen the international benchmark return over this 9-month period. So you've actually seen the international markets catch up to the US markets. And then fixed income, we talked about the good returns up over 3%. You can see both of these funds outperform their benchmark for the quarter. And then you look out a bit longer term, Western still underperforming, down about 8% over the last year. That's about 3% worse than its benchmark, Bloomberg aggregate. And if you look over the past 3 years, they're down pretty much in line with Bloomberg aggregate. So again, I think, important to separate what happened last year with what the potential is going forward. And I think Western, the way they designed their portfolio, it is a bit more aggressive, but there's a lot of yield built in their portfolio, which means barring a lot of surprises on inflation, much higher interest rates, returns in the 5-6% range for a calendar year are not totally out of the realm of possibility. So we're keeping a close eye on them, and we'll continue to give you commentary on the portfolio. So let me stop there, see if there's any comments or questions on fund performance. Okay. We've got a lot of other information here. I'm not going to go through it today, but we talked about, we look at the fees, which we monitor quarterly. We have the underlying investment funds. We look at their historical performance, break it down different ways, look at the risk. And so anytime there are questions or in the future if we're concerned about managed performance, we have these pages, we can point to them, we can talk through them.
Leslie, that contribution that's made, does that immediately get invested or?
Mhm.
Is it?
Yeah, when we go to this year we put $1.5 million in the trust, and we broke it up into 3 deposits of $500,000 each. And when we get ready to make the deposit, we then reach out to our investment consultant and say, what are we overbalanced or underbalanced? And we use the deposit to help rebalance. Yeah, and unfortunately, it's looking like next year that we will not be able to make a deposit because of our budgetary situation. But I've asked the board that I can reserve the right that if we get to the end of next year and we look like we have underspending or savings in what we call our class 12 category, that I can then choose to make a deposit at that time. So we're hoping that something will go in late next year, maybe.
I was like, the insurance council didn't have any money to give this year either.
No. Yeah, we do have a policy. We're self-insured for health and dental insurance, and we have a policy that if we're over our reserve amount, that then 25% of that comes to the OPEB fund. And years ago, we made, what, a $6 million
Yeah,
deposit?
we've made it 6 million and 3 million,
Yeah.
but yeah, we've made more often the deposit from the insurance council was larger than the levy board.
Yes. But unfortunately, our health claims have been higher than
Yes.
anticipated, big time this year. And so we have not we're way under our reserve mark right now.
Medical inflation is still really high.
It's real high.
And when you refer to year, that's the school year, not the calendar year, right?
That's
Yeah,
correct.
okay, it's part of the.
Mhm. Yeah, July 1 to June 30th.
Okay.
Yep.
Yeah, and I should have been clear in our report too. We show it both ways. So we'll have a year-to-date column, that's the calendar year, and then FYTD fiscal year.
Is your 1 year a rolling year?
The 1 year is rolling.
Okay.
Yeah, everything to the right of the fiscal year, and the fiscal year is rolling.
Is rolling,
Yeah.
right, okay.
Okay, so the next item I have is the asset allocation review. And just out of curiosity, have you all been through an asset allocation review recently?
A couple meetings ago, we did. Now, but then we've got a lot of newer folks here, so I think
Okay.
we benefit from going through it again.
Okay, yeah, and so the basis of this is, and I'll be candid, this is more art than science. So you're gonna see numbers in here. In any given year, in reality, it's gonna be much different than what we forecast. What we're trying to do is look out over a longer period of time and come up with assumptions for each asset class. So by asset class, stocks are an asset class, US stocks are their own asset class, international stocks are their own asset class, bonds are an asset class. But we need some basis, when we're making recommendations to look out longer term, look at what's happened historically, look at conditions today, think about things like inflation, interest rates, and make assumptions about what returns, what risk is going to look like over the long term. So that's what we're doing here. We update our capital market assumptions every year. And I think the reason that this is particularly an interesting year is because of those shifts in the yield curve and the interest rates that we talked about have had a really large impact on our model. And so what you're going to see is, especially when it comes to fixed income, there's a much greater opportunity here, we think, in that asset class. And so in all clients, we're seeing recommendations to increase that allocation. The first page, page 2, is just an overview of some of the themes I just talked about, the importance of diversification, of course, the disclaimer at the bottom, these are assumptions based on sort of reasonable projections. Again, in any calendar year, you're going to expect to have a different experience than what we're forecasting. But these are forward-looking estimates. So again, we are taking into consideration what's happened before, but we're trying to think, importantly about what's happening now and what that means for the future. In terms of the themes for our 2023 assumptions, there are a few important ones. And this is already probably the 5th time I've mentioned interest rates, but that is there at the top of the page and gives you those comments about why. And the impact from a modeling standpoint is that the risk-free rate, which again, think of that as a short-term U.S. Treasury, we're modeling over a 20-year period to be about 90 basis points, almost 1% higher than we had last year. And so that's going to impact everything, but especially fixed income. You see that mentioned again towards the middle of the page where it says global central banks, monetary and fiscal stimulus tightening, the last bullet point there on the right. I should go back and just clarify. So when we build out our capital market assumptions, we think about an asset class like stocks. We start with that base risk-free rate, and then we're building assumptions on top of that to get the return from stocks. Because obviously, to be a stock investor, you need additional compensation, otherwise you would just invest in treasury. So we build on that assumptions about inflation, assumptions about earnings growth, valuation, how that's going to adjust over time. And so interest rates, as I mentioned. So what you end up with, of course, for stocks is a return assumption that's much larger than for basic treasury fixed income. So I think it's just important to understand there's a whole methodology behind this that we look at, somewhat consistent year over year, but the underlying inputs do change. And the other thing is just down towards the bottom, talking about multiples. That's the last theme on the right side. You see purchase multiples still. It's actually the private market. It's really the one above that. Valuations. Even after the correction in the stock market last year, valuations, especially in the U.S. for stocks, are still pretty high. They're lower abroad, especially in the emerging world, but also parts of Europe and other parts of Asia. So just important that we are increasing that base rate, but there is some sort of what we'll call compression on the rest of the building blocks. Our expectations for the risk premium, we call it, has come down a little bit. So there's a bit of offset to that higher rate. What that all means is on page 4. And we're forecasting two different periods and 2 different types. So we do this over a 10-year period and over a 20-year period. Really, generally, what we focus on is that 20-year geometric return. For you math, you know the difference. You could probably do much better explaining it than I could. But
well, I was just going to say, what's the difference between an arithmetic return and a geometric return?
Yeah, I think a good buzzword in investments is compound returns, and that's what we mean by geometric. So you're taking into account the fact that assets are building and they're growing and growing more, right? They're compounding, and so that's why the arithmetic is always lower. Always higher than the geometric, because the arithmetic, think of that as a standalone return if you weren't taking it. So there are actuaries who look at this differently. We just sort of present it all, but I think the key focus generally is that 20-year geometric. What I will say about the 10-year is this trust has a pretty unique circumstance in that the last projection we saw no cash outflows projected until 2033. So.
Just give me your best one every year.
Yeah, that always happens. But just something to keep in mind, what you also notice is the assumption for the 10-year are quite a bit higher than the 20-year. And that's usually not the case. The reason is because right now rates are elevated. There are not many people out there who expect them to stay that way. So whether the Federal Reserve starts cutting rates later this year, whether it's next year, if you look at interest rate futures markets, really just about everybody is predicting that at some point in the intermediate future, you're going to start to see rates come down and yields come down. And the rationale is that the economy probably can't withstand these lower rates for a very long time. Now, you can challenge that, but again, the timing of that, less important, I think, than what it means for the numbers here, which is that you see 10-year, you see that normalization not really take full effect. You see it take more full effect in the 20-year, because again, these are sort of averages over time. So if we look at the 20-year geometric for stocks, US equity, we're projecting 7.5% return. That's an annualized return per time. International is a bit above that at 7.7. For fixed income, again, this is where we see the biggest change, close to a 4% return we're projecting. That was closer to 2% when we did this last year. And then we have these alternative asset classes. I'll spend just a minute on what each of these are. Again, you don't have these in the trust portfolio today, but I think there are areas that we want to at least do education and take a look at, and then you can decide whether you think it makes sense. The first is multi-asset class solutions. That can mean a lot of different things, but typically it's one investment vehicle that combines things like stocks, bonds, could have commodities, could have real estate equity in the form of a real estate investment trust. So it's typically a more diversified investment than just a stock investment, just a bond investment, but it has components of sort of all of these asset classes.
Are those normally actively managed?
Yes.
Okay.
Yeah, and that's an important part of it because they're typically more expensive there.
Okay.
So when you're making that decision later on, that's something to keep in mind. You feel like, hey, we need this in the portfolio and are willing to pay the fees that it demands, which will be higher than what you're paying now. Anything else. Private credit is another one and can mean also a lot of things, but the idea is lending that is unbank related. So we saw this area really explode post-financial crisis in 2008, 2009, where banks either necessarily or by choice had to step back from a lot of the lending they were doing in the corporate world, in the asset-based world. And private investors essentially came in and filled the void. And what that meant was we were living in a world where bonds were getting you 3%. You could go invest in the illiquid private debt markets and get 8-9%. So it's still an opportunity that's out there today. There are a lot of people who are scaling back because we're now getting paid more in the public markets. Public markets are more liquid, as we know. You can get your money out sooner. They do tend to be lower yielding or lower returning, but it all depends on the rest of the portfolio and what you think you need. So we're going to do a lot of education on private credit. To me, education first, and then looking at specific opportunities. So more to come there. And then the last one is real estate. And this is I think historically, the first place to look outside of stocks and bonds for diversification with real estate. And it's just such an unusually difficult time right now for commercial real estate that we're urging a lot of caution here in terms of the timing of investing. So obviously higher interest rates again, but also the fact that banks are pulling back on their lending is making it tougher for owners, landlords of commercial real estate to get financing. And meanwhile, pretty much every real estate manager that we work with and talk to is forecasting continued write-downs in their properties, especially in the office sector. But even in multifamily apartments, things that have been pretty resilient, industrial properties probably remain pretty resilient, but there could be quite a bit of pain left this year for real estate. So again, we'll take our time there, a bit more so than private credit, do some education, look at what's out there. But longer term, that could be another component to consider.
I know we talked about real estate a couple of years ago, and I know a former board member that was sat on board. I mean, we talked about the concern of real estate and what the pandemic did for a need for, office building, corporate buildings, that kind of thing.
Yeah, it's staggering. I was in DC again yesterday, and between the office and the retail vacancy, it's Gallery Place of all places. It used to be the center of the city. It's shrinking. On page 5, just a note, correlation is the other input. So we'll talk about risk in a second. Returns, we know those are. Correlation is how things interact over time. And so that's how these inputs give you the benefit of diversifying. So we make assumptions based primarily on history about how asset classes interact. A high correlation, so a number close to a positive 1 means two things move. I've got here. If it's low or negative, it means they move in different directions. So when you're thinking about adding things, you want them to be lowly correlated because you want the benefit. When one thing zigs or zags over time, both go up, you have a smoother ride than you would otherwise. Okay, so here is another eye chart on page 6, and this is really the meat of everything. So what I'm going to do is just focus first on the current policy, just to get everybody their bearings on what it all means, and then we can compare it as we move from left to right on the page. What you see in the left column, the first green column, is the current policy. So that's the policy you have adopted now. You'll see that the U.S. equity, for instance, the target is 55% of the total trust assets. You add in international equity, and you have 70% of the portfolio in equity. Core fixed income is 30%, and those are the 3 asset classes: U.S. equity, international equity, core fixed income. We talked about the other asset classes. There are no current allocations. If you look further down on the page below the total 100%, you'll see the 10-year expected return, 10-year arithmetic and geometric. We talked about what those mean. Standard deviation. So this is the most common measure of risk. And the best way to think about standard deviation, if we contrast it to the 10-year geometric return of 7.1, what that 14.1 means that in any given year over the 10-year period, there's a reasonable expectation, about 2/3 of the time, that you could see returns 14% above 7% or 14% below 7%. So it's not the most precise measure of risk, but it's a common one. I think it's a good way just to get a sense of how much variation you can get around that 7.1 mean. And then we talked about 20-year, and that's really going to be our focus. What I would highlight on the current policy at the bottom is the 20-year geometric return assumption is 6.8%. Again, the actuarial assumed rate today is 6.5. When we ran this in the RFP process, that 20-year geometric return was 6.1. So about 70 basis points, 0.7% increase in just a year. And that goes back to the point on interest rates. So then we started modeling out from there. So if you go one column to the right, what we said here is, all right, 6.5 is the actuarial assumed rate of return. Whether that should or shouldn't be better or worse, we're going to model to that. And so if you look all the way at the bottom, you see 6.5, you see that match up. I think the key takeaway here, if you go back up to that standard deviation line, the volatility, we've gone down from 14% to about 12%. The Sharpe ratio, which is the line below standard deviation, is the ratio of essentially return to risk. You want that to be higher. How much return are you getting per unit of risk? It's about the same. There's no real movement there from one portfolio to the other. Part of that is because we still haven't introduced the other asset classes, the diversifying asset classes. But then to the right of that, what we said is, okay, we dropped equity by 10% in the prior scenario. Let's drop it again by another 10%. And we're also going to take 7.5% from bonds. And those are going to fund 2 new allocations. Max, the multi-asset class solutions at 10%, private credit at 7.5%. And this is where you see that Sharpe ratio start to move. So it increases. You've actually decreased the risk from 12% down to about 11.4%. And you've actually seen the return go up from the second scenario to the third scenario. It goes up from 6.5 to 6.7. So that highlights the benefit of diversification. And then the last portfolio, we're also incorporating real estate. I think for the purposes of the proposed update to the policy statement that we'll do for the next meeting, we won't include real estate just based on the comments I made. But it's something to keep in mind for longer term, and it does further enhance the diversification. I'm going to skip a couple. I just want to show you the risk allocation, page 8. So page 8, these aren't percentage of capital that you're seeing. They're the percentage of the risk. How much of the risk, that standard deviation, is coming from each asset class? When I look at this analysis, this is the biggest concern, is that you've got almost 96% of the risk coming just from stocks. Not surprising, stocks have more risk than bonds, but we're forecasting that volatility is going to increase relative to last year. And even when you start to diversify, you're still in the second portfolio, you're still at 92%. So all that's to say, you should take steps to diversify that risk. You have a unusually large percentage of your risk concentrated in equity.
And it's interesting, our actuaries normally are conservative by nature. They argue with us because we're so low funded. He says, and I'll take for example, we're 20% funded. So he says, if you're gonna take the risk, take it now, and then wane off as you get more funded. Now they're very controversial, because he says, okay, say you lose 2% this year. So you're gonna go down, you'll go down to 18%.
Right.
He says, what's the difference between 18 and 20, really? It's not a whole lot. I mean, you're still very underfunded. He goes down. If you get higher up into the 80-90 funding, then you gotta be careful.
Right.
So it's interesting, how much risk are we all willing to take at this point in time with the percent funded we are?
I think that's a fair point, and obviously time is on your side in terms of having a long 9-10 years until you need to start making distributions. But I would argue, when I look at this on page 6, it's telling me you don't really have to sacrifice much in return, and you can still bring down your risk. So, I think you wouldn't actually take concrete steps to do that until you adopt a policy statement. Wanted to put it on the table today. If you wanted to take an interim step, we talked about, there are bands around sort of a minimum and maximum threshold around the targets that you're allowed. So within your policy statement today, you could take a slight step, and you could increase your fixed income by 2-3%, maybe $5 million, take it out of equity, just as a small step to add a bit more bonds. But you're not going to take a larger step until you adopt your policy, which, I understand will take a little bit of time, but we present as recommendations in the next meeting.
Yeah, when I met with the board the other night about appointments, I explained that the investment policy statement is set by our board, and it's like the guardrails on the road. So there is a range within that we can go.
But that does give me, at least gives me comfort to hear that too, because the urgency to do this, may not be there. You could take a meeting or two you can take the time that you need to make the change, especially if you're not concerned about having, and your actuary is not concerned about having that volatility early on. But over time, I think you can still take these steps, diversify the portfolio, and still get whatever return you need to get where you want to go. I'll show you one more, page 11. And this goes back to that point about why, there's a lot of buzzwords here, but the point about why the 20-year projections are lower than the 10-year. And it really ties down to that chart at the bottom, what we're expecting cash to return. So when we say cash, we're really talking about treasury bills, very short-term credit risk is really the safest debt. I should be careful when I say that, it's a ceiling issue, but and you can see over time that return assumption for cash comes down from 3.9 for 5 years down to 3.1 over 20 years. And to the right of that is just showing how much that has increased versus last year when we did this analysis. So again, that is a material change.
Yeah.
I talked a lot. Any comments or questions, thoughts?
Leslie, when we make decisions and if we were down the line to change something, I know we come together or whatever, usually how long is it before it gets on the board, to approve?
For the IPS?
So any of those kind of things, that has to go to the board to, how long does that usually take from the time we have a meeting to?
Not long. I mean, once it gets on an agenda, the last year when we changed the IPS, we were on within 3 weeks.
Okay.
Yeah, we were on the next board meeting. Because that went to work session.
Okay.
Honestly, it had very little discussion, because they do rely heavily on this committee to make the recommendations of the changes. If we wanted to make a change, like Christian was talking about, within the current allocations, we can do that ourselves.
Right.
And we could do that probably tomorrow, if we wanted to, move the money.
Gotcha.
I skipped over just an update. You don't have this in front of you, but I'll just note, we did run the market value report as of the middle of May. So this was as of May 16th. The assets were 158.5 million. So that was down about 370,000 from the end of March. So, again, with all the all the debate around the debt ceiling, and what the Fed's gonna do next, or they're gonna hold, or they're gonna hike another 25 basis points. We've seen a little bit of volatility, but that's less than 20 to 30 basis points negative return overall. And some asset classes, large cap equity, has continued to do very well in the US, international equity, and small caps have done a little bit more poorly. Part of that is tied to some uncertainty in the banking sector. And bonds yields have moved up a little bit, so it's uneven, but not a material change. All right, the last item I have is the proposed agenda timeline report. And this actually does have embedded in it the one recommendation for today.
That is, does everyone have that map, this proposed meeting agenda, action timeline, little meeting?
Okay, so
Yeah.
I don't think I have it, but I have it online.
There's an extra right here.
They got two. I have got it.
That's an extra.
you want to?
No, I got it.
All right, so the recommendation, today the trust is entirely, so for the US equity portion, US stocks, is entirely passively managed. Passive meaning the objective is to track an index, as opposed to paying an investment manager typically much higher fees to try to beat an index. The higher fees are because they have to hire a research team, they invest in various systems they need, et cetera. But there has been a big move over the last, really more than 10 years now, towards passively managing a large component, at least, if not all, of US equity in institutional portfolios. And I'd say that trend has not let up at all. So the two components in your US stock portfolio today are a large cap index with Vanguard that's tracking the S&P 500. And the S&P 500 is large cap, the large cap segment of the US stock market. And then the Fidelity Extended Market Index, which gives exposure to mid cap and small cap. So when I say cap, market capitalization, you take a stock's price, you multiply it by the outstanding number of shares, and that gives you the market cap of the company. So obviously the S&P 500 one is going to be dominated by the Googles, the Apples, the Microsofts of the world. The mid and small cap are going to be primarily names that you haven't heard of. You may have heard of some, but they're more burgeoning businesses. They're much smaller. But this does give you the total exposure across the US equity market. The fees right now for the S&P 500 are 3.5 basis points, 0.035%. For the Fidelity total market, it's 0.15, for the Fidelity extended market, it's 0.035. For the Vanguard S&P 500, it's 0.04. That's perfectly reasonable. When we looked at this, we have clients that have used this Fidelity total market index, which hasn't been around as long as the Vanguard index, but it combines it all into one. And it does sit at 0.015%. So that's a long explanation to say you could simply consolidate the two into one. The trust would save about $20,000 a year in fees. And to us, it's kind of a no-brainer. So just wanted to put that out there as a pretty easy recommendation. We think the dollar amounts today, Vanguard is about 71 million. Fidelity extended market is about 14 million in terms of the total assets, so about 85 million in total assets.
Performance is about the same?
Yeah, I mean, so right now, because you have the two pieces independently, how they perform is really driving which one is allocated more or less. So for instance, in the first quarter, because large cap stocks did so well, you have the two pieces, large cap becomes a larger component. If small caps did better than large cap, they become, proportionally a larger component. This takes all that out of the mix. I mean, the difference is about 8% right now in terms of the large cap allocation based on the current mix versus if you just move to the index, the total market index. The point is that you're not making, as far as I know, any active judgment on what that mix should be. So if you just buy the whole US stock market index, you're letting the stock market decide. So there's a little bit of, that's the biggest change, would be the biggest difference, is that there's about 8% less right now. I tried to do this back of the envelope. 8% less right now in the total stock market index in large cap equity than there would be relative to the current mix you have now. But that's going to change over time, your current mix. So I wouldn't say it's immaterial, but again, if your objective is to get access to the U.S. stock market, just take the whole thing. And even with the total market index, the performance is still going to be largely dictated by what happens to the largest stocks, because that's just the reality of the way these benchmarks are built.
In the total market index, do you know the split between large and medium and small?
Yeah, it's historically it's been about 70% large cap, 20% mid cap, and about 10% small cap. Now again, that's going to move a bit quarter over quarter, year over year, but that's a pretty good rule of thumb.
Leslie, I feel like Vanguard's been in this since.
Well, I think day one.
Yeah, they essentially started it.
Do we remember why we had it split like that? I mean, was there a strong reason why we have those two separated versus?
We started with Vanguard when we were a much smaller trust. We just went with the more bigger blue chip type of companies. And then as we got larger and had more, we diversified at that time. Gosh, it's probably been 15 years ago.
Yeah. So basically the argument then was to be more diverse.
Right.
Versus lumping them into one.
I'll also say that the fees have continued to come down, and for a total market index like this, you couldn't get that pricing 5 years ago. 2008, when you could not. No.
Does their size affect the fee also?
No.
Okay, so the 85 million doesn't change what the fees will pay.
No. Okay. In a lot of cases it will, but because these are institutional index funds, 1940 Act mutual funds essentially, they can't really look at the individual investor and make decisions about what they're contributing. You sort of pay the price, the sticker price.
Okay. No haggling on that one. Thoughts?
I like cutting fees. Fees are real money, so
Mhm.
fees are a guarantee, so you know you're paying those. And if, I would assume also that the risk is probably a little more balanced.
When you combine the two that you have now and compare it to what's on the table here, it's basically a wash. I mean, you're talking about very small differences in terms of the underlying allocations. Over time, I can predict one way or another, one would outperform it. If one did, it would be marginally.
Yeah, I think $20,000 is real money.
Especially when you do it over time, as we were saying.
Yeah. And not to disparage what was done prior, because I think that's a common strategy, very common strategy, so it's not a negative toward the original strategy, it's just times have changed.
No, but we have plenty of
And
clients.
there's an opportunity there to.
I make a motion to replace the Vanguard Institutional Index and Fidelity Extended Market Index with Fidelity Total Market.
Any discussion? Yeah, I gotta know how to run a meeting too. All right. If there's no discussion, we'll vote on that. All those in favor of the motion? Raise your hand. That's unanimous. Thank you. So from an administrative perspective, do I contact our custodial bank and tell them what we're doing?
Yeah, we'll get, it's probably a trade form, or maybe two of selling about
Only a
it.
trade ticket, yeah.
We'll tee those up for you and then you can decide inside.
Okay.
In terms of the timeline proposed here, so for the next meeting, which will be virtual, and we'll have Tanya for that meeting, and I will be on an airplane vacation. But discussion of the investment policy statement as we discussed, and showing you, what we're proposing in terms of the asset allocation, and then education. So this will be the first session on private credit, and just doing, really talking about what that is, what it can mean, the different types. And our colleague Joey Mallon, for those of you who were the RFP finals presentation, he's sort of our guru when it comes to private credit. So he'll do an overview of the asset class and answer any questions you have. And then November, assuming you want to proceed and go further down that way with private credit, we can have a presentation from a private credit manager. In some instances, it might not be as essential to hear directly from the manager, kind of like, this Vanguard and Index Fund, but in the case of this, where it's a very specialized type of investment, I think it'd be very helpful for you to hear from somebody directly, maybe two firms, so we can figure that out after the next meeting. And then, we talked about international equity. The manager you have, the fund you have now has done quite well. There could be an opportunity there just to diversify and have a second fund. So we can do that as a consideration. And then on the next page, fixed income, Western, as we talked about, it's remained on watch, revisiting how they're doing, looking at that structure and the mix you have and just making sure the allocations are right, thinking about whether you want to consider adding a different fund to replace Western or potentially a third fund. And then getting to this time next year, I think that would probably be a good point to revisit real estate, to an in-depth discussion and review of what's going on in the world, and potentially start to look at multi-asset class. In terms of the multi-asset class manager and pushing that back, I think that's okay. Part of that is because right now this fixed income environment is much healthier, and that's going to help you get a lot of the return that you need to get to that 6.5 or maybe more. So I think we can push that a bit further back on the agenda. That was the rationale for having that. Idea overall is to have about 2 topics per meeting, because that's going to eat up an hour and a half. Probably your attention span too.
Tony and I can go longer.
Geek out. We just geek out. One thing we
Go
did-
home and pour over all that.
Knowing that we're gonna go on over 2 topics, I mean, look, today we've gone out already. So we'd like to move the meetings to an hour and a half on standard, just scheduled meetings, so we have plenty of time to discuss these. I've also asked Christian on the IDS for the next meeting to get that a couple weeks in advance to us, what their recommendations are. So that you guys have time to look it over, and if you have questions, ask them ahead of time would be great. And then that way we can be prepared to have more of an efficient discussion at that August meeting. So,
Questions?
yeah, they're at the bottom of the agenda. Our August date is Friday, August 18th. If you see, Lynn's put that on there for an hour and a half. And then the November, she's actually already mapped it all the way out for the year for us.
This questions would come back to you and then you.
Yes. Actually, Lynn takes care of all that.
I have a question. I'm just wondering, like, whenever someone is put on the watch list, is there like a timeline that they remain on the watch list? Or like, and if they don't improve within a certain time period, would we make a change? Would you recommend a change or?
It's a great question. The way the policy statement is currently written, it's pretty flexible, and we work with plans that are pretty systematic about the way the watch list works. I've always sort of tended to not take that approach because I think there's so many elements that you can't pick up in numbers, which are really the only way to. So rules-based watch list, you're basically, and you do have this in your policy statement, there are expectations for outperformance, 3-5 year period, longer term, and I think those are important, but there's also fundamental things about a fund and investment company that can't get really picked up in those numbers. Who's running the portfolio, if anything changes, has the philosophy changed, is the organization and upheaval. So I think it's a mix. You sort of look at the numbers, but then talk about what else is going on, and you make those decisions that way. If you have a manager that's on the watch list for performance for 3 years because they're just underperforming every year and you can't give a good explanation why, well, rest assured I'm going to have a recommendation to sort of move on. So that's how I look at it. I think generally I'll just comment that I think the policy statement is well written the way it is now. So we'll suggest a few things just based on the way we do it, and of course the asset allocation component, but I think that's a pretty reasonable overall way to handle it.
Any other questions?
If I remember in your RFP, you kind of had a recommendation in there. It seems like this process has taken us through that, to get from where we are to whatever.
Yeah, that was the idea.
Yeah. think I remember seeing this one recommendation that goes to the total market
Yeah.
index in there, so we get step one.
You have a good memory.
Yeah.
Just,
He's retired. He's retired the rest of us.
The brains are
We
together.
need people like that on the committee.
You darn right.
Yeah, that was the idea. I mean, I think, you know, the timing, we've sort of had to think through that and how we want to structure each meeting. But generally, the themes that we saw that we want to try and improve on were, you know, managing the fees where we could, improving the diversification, even if that happens over time. And overall, I think we made this comment. I mean, the managers, the funds that are in the portfolio are not bad ones. I think the bigger opportunity is just expanding, looking at those other asset classes. And potentially further diversifying. International equity would be one example, where you have one fund, a bit more growth tilted, you have a more value tilted fund to sort of, you know, balance that out. But yeah, I mean, over time, I see a lot of potential here. But also, you know, something like private credit, you might be able to get to that 6.5 comfortably without it. Doesn't hurt to look at it and consider it and just learn more about it.
well, from the RFP process, my takeaway was people thought we can do, you know, 6.5 was a lower benchmark. We could do, you know, something better, you know, without any more risk.
Yeah, I don't think there's any question that that's what this is showing. I mean, it's, you know, again, about 0.7% higher in just the return assumption year over year, based on relative to what we showed you not long ago, because we hadn't quite gotten there in our 2023 assumptions yet. We try to have those done by about February of each year, but this was a heavier lift than last year.
I will tell the committee, every 2 years, we're required to redo our actuarial study on OPEB and what is our liability and all. And so that work is starting to happen now. As of July, it'll start. We normally go in front of the board in November. It's the Monday before Thanksgiving. We bring the actuary in and actually go over everything with the board and talk about where we are with our liability, has it gone up, has it gone down, what the factors have contributed to it. I will tell you, with claims being up, that's a huge factor. So I would anticipate our liability is going to go up probably significantly. More retirees. And more retirees,
More.
yes. Living longer, more retirees, living longer, yes. So, you know, all of those things go into the factors when we do the actuarial study. So it's very interesting.
Like, if everybody retires today and you have to pay all of their insurance for the rest of their life in one lump sum, that's what the final dollar amount is.
Yeah.
Which is an imaginary scenario.
It's, mind-boggling. Right now, we pay for our retiree health care out of our general fund. And it runs between 14, 15 million a year right now. And we basically pay it on a premium basis. And so we always say that there's a time there's going to happen where that gets so large that we're going to need to tap into this trust fund and start supplementing it. And, you know, we like to hold out as long as possible because the more assets you stay in there, the bigger they grow. So that's kind of where we are right now. We're fortunate that, you know, like I said, that number has stayed pretty consistent. It's not a big number of retirees, but
It's not exploded.
yeah.
Don't say that.
Really hasn't. It really hasn't. I said they all retired during the pandemic. It's actually slowed down a little bit.
Yeah, it's a good work on it.
Still sometimes when like the last board docs I look, I'm like, oh my gosh, it's a total, it was like almost 200 years of experience who are retiring.
Oh, yeah.
Just the
Oh,
last,
right.
the last.
There was that one though, that was like 800 years of experience.
It was, that was the pandemic. I can't
She was like, oh my God, we lost 800 years of experience in this board docs.
When they list our retirees for a board, they list how many years of experience, so how many years they've been with us.
Yeah, and we had one gentleman who had 52 years of experience in teaching math in the school system, but lots of people who were like 37, 38, 40, the pandemic drove them out. They weren't all, you would think with those numbers, they were all ready to retire, and they weren't, but they were like, oh.
Yeah. Yeah. So are there any other questions? Well,
I appreciate the presentation.
Stand
Thank you.
adjourned.
Really
Thank you
pleasure
very
meeting you.
much. And we'll be back together on the 18th of August virtually. All right, help yourself if you need any refreshments before you leave. You got all that, Catherine?